All right, David, thanks for joining the chat today.
It's my pleasure.
So we agreed we're gonna just chat about our option selling strategies and just share it on YouTube.
Mhm.
All right, so let's start with, I guess, background. Like I've seen some of your videos. I know you used to work, I think, in investment banking, right?
Yeah, you're Canadian. I used to work at CIBC World Markets.
Okay, yeah, okay. Are you Canadian?
No, I'm American,
Okay,
but
okay.
I know that they have a retail presence in Canada. In the United
Absolutely,
States,
yeah,
they
yeah.
do a lot of institutional. So I worked in the Industrial Growth and Services group there, and that was actually my first job out of college as a banker, and it was hard, but I guess it was worthwhile.
So what does that mean, banker? Like investment banker? Do you have to like pick stocks and research stocks and pick them, or?
No. So what we do is we would look at an individual stock. So if I was in industrial growth and services, then I was dealing with a lot of like metals and mining stocks. And we were evaluating like mergers and acquisitions of companies within that specific industry. And then also if a stock was really expensive. I remember when Nova American Steel, I think the ticker symbol at the time was like NOVA, was trading at about $90 a share, and it increased from about $20 a share. We then pitched Nova American Steel to issue new equity because we felt that their stock was overvalued. So the company would then be able to raise capital by selling shares to the public that we perceive to be overvalued, considering they hit it increased in price by about 300% in about a year. So a lot of like M&A, a lot of pitching, but the reality is that investment banking, it's not sexy. I put in a lot of work to get that job, and they use a lot of fear to make you feel that you are lucky to have that job and that a
Okay,
thousand people would gladly take your position. But the
okay,
reality is that the sacrifices that you make are not reciprocated. So the company wants you to give 100%, but then if you get sick or if you don't feel like working until 3 o'clock in the morning, instead of looking at it from your perspective and you trying to make sure that you're healthy, instead they threaten you and they try to force you to do what they want. It's all about control.
okay. And I guess it's salary or commission. There's no commission because you're not really selling anything, right? It's not
The
a commission
managing
job.
directors,
Yeah.
the managing directors get now I was never a managing director, but they get a base salary, and I'm sure that they negotiate in their employment agreement. They don't call it like a commission, but they get like a percentage of the revenue that they generate.
Okay.
As analysts, associates, even vice presidents and executive vice presidents, you get a salary and then you get a large bonus at the end of the
Okay.
year.
So I think from your videos, I remember you didn't enjoy it. Like, what didn't you like about it, and or what did you do after investment banking?
So what I didn't enjoy was I got sick. Like a lot of people who were in investment banking, it was just the stress, just lack of sleep, the stress, the fear,
Burnout.
the
Yeah.
agitation. It just started like wearing away at you. And banking is really about survival, where a lot of people who start off as analysts, they want to be like the very best analyst and they want to give 100%. But if I had to do it over, if I was forced to go into banking, then I would just try to survive those like first 2 or 3 years. And yeah, what happened after was I did banking for about 5 years. And then I just needed to stop and like take care of myself and get myself healthy again. And then, I started trading.
Okay. So how'd you discover options?
Well, I was always interested in the stock market. I mean, even when I was like 18 years old. And I realized that every other strategy that I tried, when I made money, I didn't feel like it was consistent. I didn't think that it was replicable. So, okay, great, like buy and hold. As long as the market goes up, then
Yeah.
you do well, right? But you're not necessarily like in control. It's like really passive. So with options, I felt like it's a very high probability of profit where even when I initially started, I remember like one of my first options trades was Google was trading at, I think around like at the time, maybe 900. And I was thinking like, oh, I would want to buy Google right now. But then I thought, wow, I can sell like the 880 strike and I can actually buy it for less money. And in the worst case scenario, I can pick up like $25 of premium here. Now, at this moment, I wouldn't make that trade because selling something that is only about like 2% out of the money, in my opinion, is like very risky. But at that time, when you're learning and experimenting, just it made sense, right? Instead of just buying and hoping, you can actually get paid to buy something at a lower price. So from a theoretical perspective, it made a lot of sense to sell options. And then you also get into the fact that you're like acting like an insurance company, and insurance companies are extremely profitable. That's how Warren Buffett made the majority of his income. And you can just, insurance is overpriced and you can do very well.
Yeah. Yeah, I started off swing trading. So I'd wait for something to drop, quality stocks. I'd wait for them to drop. I buy them, and then I have to wait for them to go back up, and then I sell them. And so I make a 10% quickly. But then at some point I'd buy something, but then it continues to drop. So then what do I do? I, I would buy more of it when it drops like another 10%. But then it continues to drop and then it stays flat. So that investment is gone. So then luckily I wasn't putting in all my capital in one place, but then and then I'd have to look for something else, wait for it to drop, and then wait for it to come back up to profit. So like wait, you have to wait twice. Basically, you have to wait for it to drop, and then you need it to go back up for you to make money. So and then I think after that I discovered covered calls, and then I discovered the iron condors and credit spreads. And what I like about options, like you mentioned, is basically you don't have to wait for anything. The stock could do whatever it wants. It could go up and down, stay flat, and you could still make money. So that's theoretically that's what was attractive about it. Is I don't I don't necessarily have to care what the stock does. And especially when you sell puts, if you sell it out of the money, the stock can go down a little bit, it can stay flat, and it can go up, and you make money in all these three different scenarios. So yeah, so that's what's great about it. Exactly. Well, like, how'd you learn options? Just like through YouTube channels or just?
I because I started selling options around 2010, I kind of learned through experimentation.
2010. Okay, wow, almost 11 years. Okay.
Yeah, I learned a lot through experimentation. And initially, I was trading like a very small percentage of the portfolio as options. And initially, I was trading as naked. And then I remembered, and then I figured, okay, well, if the tail risk is a major factor in determining whether a trader is going to be profitable, then you can sell spreads. So I kind of just slowly but surely, and then Tasty Trade came along, I think around like 2013 to around 2013 or so. And then initially I was like, oh, wow, these are like all the things that I've been thinking about and the ways that I've been trading. And then even though I don't agree with everything that they say, I think it's an incredible resource where
Yeah.
it just validated and then it threw ideas out there and sparked the ingenuity where you can decide like what are some facets of Tasty Trade that you agree with, what are some facets that you disagree with. And I think that it's a great free resource that people can utilize in order to optimize their trading. But I think that the way that I started trading was really just a lot of like just trial and error, and then also like just working through some theoreticals like in my head, like I would just be thinking, okay, what happens if the stock falls this much, or what happens if the stock increases in price? Or is it then worthwhile to sell a call, or is it worthwhile to sell like a covered call, or to sell a call spread, or something like that? And just also learning from experience. You go
Yeah.
through what happened in like August 2015, where everything was fine. And then I think it was like August 21st, 22nd, and then 24th, where the VIX increased from, up to around 40. And then you also, in December 2018, where it was like a very large drop. And then also February 2018, where I think February 5th, which was like a Friday, where the VIX increased tremendously. I think at that time it increased to over like 50. And then obviously like March 2020. So you learn through experience, and then you take it from there. And I think the biggest difference from the person that I am now relative to the person that I am, the trader that I was like 10 years ago, is that I realized that my primary goal is not necessarily to make as much money as possible. Instead, my primary goal is to minimize pain and to reduce risk. Because by selling options, you know that the actual volatility is almost always going to be less than the expected volatility. But you always have to keep in mind what happens during the times when the
Definitely.
expected volatility is actually less than the actual volatility, and the actual volatility is more than the expected volatility, and the VIX increases by 50% in like a day or two.
Yeah.
You have to make sure that you're protected. And I think that one of the big drawbacks of selling options is you can win 98% of your trades, 95% of your trades, but you can actually still lose money even by winning 95% of your trades.
Yeah.
You always have to think about the worst case scenario.
Yeah. Yeah. So what is your what is your approach? Like, what did you do in March? Like, how did you survive COVID? How did you survive March 2020?
So March was difficult, simply because of the magnitude of the move. I think that I got really lucky in that in January and February of March 2020,
Yeah.
the market was so euphoric that
Yeah.
I didn't trade that often. So I wasn't trading that heavily. And at that time, the VIX was really low.
Yeah.
So in March, I lost money and I had to defend the positions, but it wasn't nearly as bad as it would have been had I traded a lot larger.
So
Because
how much of your portfolio were you using going into March,
it
percentage
was
wise?
really it was really low. I don't remember the exact amount, but
Or
I know that
percentage, yeah.
as
Like,
far as like buying power usage, it
yeah.
was very low. So
Okay.
usually what happens is I try to, when I am fully invested, if I'm trading naked options, I will use up to 60% of my account and then
Okay.
leave 40% of the available buying power as excess liquidity. And then that'll provide a safety net.
Yeah.
But because the VIX was so low
Yeah.
in February, and not only that, but it was almost like euphoria. Like, we're in a euphoric stage when buying stocks is more profitable than selling options. Like when you see a situation where the stocks that you're buying, like long stockholders are making money hand over fist, and you can
Yeah.
actually make more money by
Yeah.
buying and going long stock, which is
Buying and
exactly what
holding, yeah.
happened in January 2020 and through the first half of February 2020. And people were just buying stocks and then they were going up like 20 or 30%. That's not supposed to happen. So when
Okay.
there's such a euphoria, I really cut back on capital. I will say that because I have a trade alerts product, I feel sometimes I do feel a little bit of pressure
Yeah.
to make trades where if I didn't have students and I didn't have a trade alerts product, I would probably trade significantly less. And I do think that
Okay.
by being more active with the trade alerts, I feel that I potentially lost a little bit more money than I would have lost, just because if I go 2 weeks without placing a trade in my trade
Yeah.
alerts, then people are going to send me a message like, hey, like, what the hell's going on? Like,
Yeah.
I'm paying you, but what are you doing? Like, but what people don't realize is that you're not going to make money by being active. You make money by making good decisions.
But it's hard also to go 2 weeks without trading, though, like especially as an option seller.
It is.
I usually can't wait for Monday just to look for stuff to sell.
Yeah.
But
Yeah.
what's your bulk like? I know you used to do naked, and then you had a video where you said you're gonna do put spreads because of capital efficiency. But I hope you realize that it's hard to roll credit spreads. So did you go back to naked instead, or
So I do
what are you
both.
doing?
I think that
Okay.
um, spreads have, I prefer, actually, I wouldn't say that I prefer. Okay, when the VIX is trading below 20, I think it's important to trade spreads because it protects you against a volatility expansion. The problem is you have to resign and accept the fact that when you are trading with a low VIX, especially when you're trading spreads, you're not going to collect that much money. So if the VIX is below 14, or if it's, and I'm not 100% sure that, because remember, March 2020, the magnitude of the move was so large that it's possible that 2 years ago when the VIX was trading at 12, it's possible that now the low of the VIX might be 14 because no one expected, and there really weren't any models to have such a large magnitude of move like we had in March 2020, where the S&P fell like 36% in 33 days. So I guess my point is, just like in 1987, when you had that crash, then there was put skew, and then puts were more expensive than calls. I do think that there's a possibility that the low of the VIX, instead of being normalized to about like 12 or 13, I do think that it's possible that the floor of the VIX might be elevated more towards like 14 or so. But even so you might collect slightly more premium. But I think that when the VIX is trading below 15, if you're going to trade spreads, which I think is smart because it protects you against a volatility expansion event, I think you have to be okay with earning less money and realize that you're going to make that money up when volatility expands.
So in March, you were holding a few naked positions, but not a lot. Did you roll them or did you close them and take the loss?
No, in March, what happened where in March 2020, I was trading spreads.
You were
and
trading
then
spreads? Okay.
the positions that hurt me was I rolled, I think it was Lockheed Martin and maybe Raytheon. I rolled that from a spread to a naked option, and I rolled that down a little bit too early. So I took a loss on those two positions. But besides that, like, it was okay. But there was one time, I think, because from my recollection, like the first week of March, from like March 1st till around March 6th, like the market went up. But then it was between like the 10th and like the 15th or the 10th or the 16th was like a really bad day. But I rolled it too early. And I think the learning lesson is when the VIX is low, trade spreads, but at the same time, it's okay to keep your position on as a spread, because when the market is oversold, if I had to do that over, instead what I would have done, even if that position was in the money. So let's say, let's use not just like Raytheon or Lockheed Martin. Let's use something like Facebook or something. Okay, so Facebook, it's trading around what, like 330 or something. So let's say you're short a put spread on Facebook. You're short a 300 by 290, and let's say the market falls down to about 260. So right now it's trading at 330. Facebook within 2 weeks trades down to 260. I think in that situation, it's okay to have the perception or have the belief that Facebook is potentially oversold. And what you could do is you can either roll that out in time and increase the width of the spread from $10 to $15 in order to decrease because it's almost like a box, right? So you can increase it a little bit by, let's say, $5. You can increase the width of the strike increase the width of the spread rather by 50%, and then you can roll down that box or roll down that spread.
The short strike, yeah.
Right. Alternatively, what you could do if you wanted to participate in the upside, because you're of the belief that the stock has fallen too far too fast, you can actually roll up that short in the money put strike and then capture the intrinsic premium. So if Facebook is now trading at about 270 and you're short the 300 by 290, you can actually, but just 2 weeks ago it was trading at 330. You can roll up that 300 short put, roll it up to about 315, and you would capture all of that intrinsic premium. That way, when the market bounces back, similar to how it did in March 2020, you would actually be able to participate in the upside, because as the stock recovered, you could actually participate. And I think that's one of the great benefits of trading vertical credit spreads, because if you were only short the naked put, you wouldn't really be, you could do that, but you have more concern over the downside risk. But because you're long that put, then you can say, okay, I believe that right now the market is overreacting. So I want to participate effectively. You can go long the stock, and then for every dollar that it increases from 300 to 315, you're essentially participating in that upside.
So that initial put spread that you open on Facebook, how much do you try to collect if it's a 10-point wide spread? Do you have a minimum that you try to collect on a 10-point wide spread?
Yeah, a lot of it depends. I would say a minimum would be probably like 5 or 10%. It really depends upon the environment, right? It depends upon what the VIX is trading at, what the IVR on that specific underlying is.
What do you mean 5-10%? No, I mean like on a 10-point wide spread, do you try to collect $1, $2?
Yeah, so I would say probably for a $10 wide spread, I'd probably want to collect around $1. But a lot of it depends upon how far it is, like how far out of the money it is, what the IVR on a specific stock is, what the expiration is, a multitude of factors. But around that, the first, sorry, go.
No, so you never confirm the loss. You never take a spread. If it's breached, then I just close it and open a new one. You try to save it by either rolling it, by increasing the risk on the spread, or by bringing the short strike even higher. Right?
What I usually try to do is I will then trade around it. So I will sometimes try to sell calls on it as well. And then what I will usually do, and in some of the videos that I posted on recently, where I had some challenge positions, I will usually like to increase the long put strike. So let's say you have, because it's less expensive to it's less expensive to increase the long put from 290 to 295 than it is to decrease the short put strike from 300 to 295. The issue with that is if you're going to do that, you're much better off doing that early. So you can't do that when Facebook is already trading at 260.
Yeah.
You're better off doing that and selling calls when Facebook has gone from 330 to 310 in about 3 days. And you're thinking, oh, crap, I need to reduce my risk. So in all situations, I'm thinking about, especially when there's a large volatility expansion event, where during that time, if Facebook has fallen from 330 to 310 in about 2 or 3 days, then you better believe that the VIX is probably gone from about 14 to about 22 to 25, because that's a pretty drastic move, right? Yeah. So there's going to be some fear. The VIX is going to have spiked. The VVIX will also have spiked. So your initial goal should not necessarily be to profit from this situation. It should be to look at all of your existing positions and how can you reduce risk. And in general, the best way that I found is to sell some calls and to then roll up the long put strike. What I'm referring to regarding rolling the short put strike in the money, that would be something that I would do when I felt that the stock was significantly oversold and that things were going to bounce back. But at that time, if it was $5 wide and I wasn't trading too large, then for all intents and purposes, then I'm not overly concerned about that position because it's already at max loss and I've already made sure that I'm okay with the worst case scenario, which is losing $500 per contract.
Yeah. Okay. Or 400. Yeah.
And, exactly. On a net basis. Right.
And would you ever, like, if Facebook went from 330 to 260, do you sell another put spread lower, let's say at 210 now, because Facebook has dropped to 260? You've got a brand new opportunity to sell a new put spread?
I think that really, that would really depend upon the situation. I think that generally what happens when volatility spikes and there's a lot of fear, your initial goal should be to reduce risk, and your goal should not, and to make sure that all of your positions are going to be okay. So
you don't keep selling? You don't open new positions when VIX is high?
Well, okay, it depends. How much buying power do you have available?
Well, if you're going in saying you haven't used much, let's say 10, 20% of your buying power, and so you have 80% available.
Okay, in that situation, it's a little bit different, right? So in that situation, if all of your existing positions are are covered, meaning that they're like you have a $5 wide, vertical credit spread on Facebook, and in that worst case scenario, it's taken care of. It's nothing that is going to force you to be in a margin call or anything of that nature. Then in that situation, once you believe that the market is stabilized and the VIX is still elevated, then I would be okay with opening up new positions.
But so what did you do in March? Did you sell in March, or did you wait in April or May when things?
No, in March, we didn't really make many trades.
You didn't trade while VIX was at 80?
Well, there was so much fear. Remember, things happened so quickly that pretty much like we didn't really trade that much, because really like things hit the fan between like March 10th and like March 20th. And then around like March 24th, March 25th is when things started stabilizing and the market started increasing rapidly. So there really wasn't that much time for you to like make strategic decisions. And in that situation, the best thing, like you don't know what's going to transpire. I believe that if something like that were to happen again, where the VIX was trading, look, what happened in March had never happened before. Never. Right? Like 2008, the S&P dropped around 50%, but it happened over a period of 18 months. So hindsight is always 2020. You can look back and look at March 16th and be like, oh my God, the VIX is trading at 84. I can collect so much premium for selling something that's 60% out of the money.
Yeah, exactly.
People are so fearful. The problem is the VIX hadn't been I don't think the VIX had been at 84 since like 1987. And the VIX wasn't even, I don't even know if the VIX was a product back then.
No, I think in 2008, it reached 80.
Okay.
But what's crazy about March is that it happened so quickly, like 3 weeks. It took 3 weeks. So
there was so much fear and panic that how do you know that it's not going to spike up to like 120? Because 120 would just be a 50% increase. And it's pretty common to see a 50% increase in the VIX in one day. Like that happens usually about like, it's happened a few times this year where you've had a 50% increase in the VIX.
Yeah, I was in February. I have this strategy where I sell put spreads on the SPY every Monday, Wednesday, Friday, 28 days. So I'm basically like tracking the market, just following the SPY, but selling out of the money put spreads on the SPY every Monday, Wednesday, Friday. Always 28 days expiration for each. And I had some in February, and then in March when the drop happened, I had a put spread at some point at 328. My short strike was 328 in March, and the SPY at some point was at 218, so it was completely breached. And I had several of them because I was opening them every Monday, Wednesday, Friday, and I even went against my rule, which is every Monday, Wednesday, Friday. When I saw when the SPY was dropping, let's say from 320 to 305 in the same day, it was too attractive for me. I sold another one the same day, so I kept selling. I kept basically catching like a falling knife, and I got burnt in March because of those put spreads. It was crazy. But if I had,
were your spreads too wide? Was that, or
they
were
were
you just selling too many?
I was selling too many. It was 5-point wide spreads, but I was selling too many because every time the SPY took a big drop, it enticed me to sell a new one.
Because you're figuring that.
Yeah.
You're thinking, oh my God, this is ridiculous. There's so much available premium. There's no way that it can fall to this level.
The SPY can't drop anymore. Yeah, it was. At some point, I had a 190 put spread on the SPY. So that was a winner, of course, 190, 185 put spread.
But I'm sure it showed you a loss just because of the fear and the increase in volatility at one time, right? So it probably showed you probably opened it up. And then even though, see, when the market crashes, it's like your biggest enemy isn't necessarily where the current market price is relative to the strike price. It's oftentimes the increase in volatility increases the option price so
your
much.
Your unrealized loss,
exactly. That even though the 190 put that you sold on the SPY might be like 40% out of the money, people are so scared that option that you sold for, let's say, like $2 is now trading at like $4.50.
But I had a spread, so I usually try to collect for a 5-point wide spread. I usually try to collect $1.
Okay.
But it was crazy because I had a put spread, let's say at 240 and 270, and then I sell call spreads against them. That was my way of mitigating against the breached put spread, is I would sell a call spread, turning it into an iron butterfly. So then I'm reducing max loss. And I actually, on some of them, I actually lost on the call side. So the
because
market,
of the volatility
no,
expansion, right?
no, because the market came back up. The
Oh,
market,
so yeah, you got
yeah,
pinball,
yeah,
right?
yeah. SPY
Yeah, yeah.
came back up, and then I lost on the call spread. So it was a ridiculous, market because it dropped so fast, and I thought it was either it was going to continue dropping, or even if it doesn't drop, it was going to stay flat for a while. You don't know
Mhm.
how long it's going to take to recover. It shot
But it
back
was a
up.
V shape.
It was
Yeah.
ridiculous. It was ridiculous.
Well,
If I had known, I wouldn't. I closed a lot of positions for a loss. If I had known, I would have just rolled for like an extra month or two, and I would have been fine. It's just ridiculous.
this question might end up biting both of us in the butt, but do you think that the market is going to experience during our lifetime another rapid fall like it did in March 2020?
Yeah, I think so. Yeah,
You
yeah.
do think, okay, I disagree.
It's my biggest fear.
I think that at a maximum it will have something that's about 70% of that, but I feel like the magnitude of that move was so violent
Yeah,
that
it's
I
crazy.
don't think it'll be like I think it'll be like maybe something that's like 70%, but it'll be something where there'll be like a mark, like a significant demarcation between, okay, this was March 2020, and then this was like this other move. Like this other move was still bad, but it was no like March 2020. So I don't think, now we're just guessing, and we're
Well, I'll tell you why. I'll tell you why I think it could happen again, because the market is so rigged and there's so many crazy things happening, like GameStop and AMC. I think it's very possible. It could be for reasons that we can't really justify. It might not even be related to the fundamentals, but yeah, I think it's possible for the market to crash again just because of all the manipulation that's going on. Uh,
so
but that's why I just feel like I have to be prepared if it happens. And what I'm doing right now is, like you said, when VIX is low, don't use all of your buying power. So I think right now I've got like maybe 70% available buying power, but I used to do more put spreads before. I only sell puts. I don't sell calls. I always sell puts, and I try to sell puts on red days. So I wait
yeah,
for
me
red
too.
days and I
Right.
sell so that my short strike is even further. And so it's even safer and I collect even more premiums. And it doesn't have to be red day on the market. It could be a specific stock that's just down 4 or 5% that day. So I'll sell on that day. So you were talking about VIX being low, but to me, it doesn't matter if VIX is low because if I'm selling on individual stocks, that stock could have high implied volatility. So
Yeah,
I
right.
don't really, VIX will affect the SPY and the general market, but it's not going to affect. It's going to affect the individual
It
stocks
does
as
affect
well.
the, yeah,
But individual stocks can still have nice premiums if there's anything. If earnings, for example, I like to play earnings. Do you
yeah.
play
I love
earnings?
earnings time. Yeah.
Okay.
What percentage what percentage of your portfolio is allocated to selling puts on SPY versus individual stocks, and which do you prefer?
No, I sell more individual stocks.
Because of the
Uh,
premium?
Yeah, because I switched from spreads to naked. I find that I've been doing better with naked puts, collect more profit, I close faster, and I can roll, I can manage easily if it's ever breached. I have a Spotify. I did a Spotify put for earnings. The stock was trading at 290. I sold a 260 put, and the strike got completely breached. And I've been rolling it since almost 3 months now. I have a 250 strike on Spotify. At some point, Spotify was at 215, 215. So I would not have been able to do that with a spread. But by rolling naked, I collect credit
You have
while I'm
much more
rolling.
flexibility
Yeah, yeah. And as long as I'm confident that Spotify is going to recover, it's going to trade back above this price.
because it's a legitimate company.
Yeah,
You're not trading like a crappy company that's been bid up that might fall to like $100.
exactly. That's the risk with naked puts. But yeah, as long as your entry is somewhat fair, like the stock had a high of 380. So when I sold the 260 put, I felt comfortable. And I was still 30 points out of the money. before earnings. So it was really just one of those bad scenarios. The stock dropped more than 30 points after earnings. And I've been rolling it. And I think Spotify's trading in the 240s right now. So if it's my expiry is in July, so as long as it,
Yeah, I was just going to ask that.
yeah, so if it just needs to be above 250, or my break even is around 246, 245. So as long as it's above 245 by July, I'll be fine. So it would have been a trade that I saved. And before entering the trade, I make sure if it ever gets breached, do I have enough buying power to save it and roll it? If I don't, then I won't enter the trade. If I feel like I'm not able to manage the trade if it's breached, then I won't take the trade, because I have no idea. I don't try to guess direction. I don't make any assumptions. I just always sell on the put side because I feel like puts win more often, and I never guess direction. I just assume that I just have to make sure that I'm prepared in if it gets breached. I know that there's a better chance that it wins, but in the small chance where it gets breached, am I able to save it? And so that's how I approach my trades. And in terms of a
You have,
crash, yeah. So in terms of a crash, it's just you can't not trade just because you're afraid of a crash or because of low VIX. But all you could do is just be prepared, and you be prepared by making sure that you have enough buying power to manage. I try to be more selective in my entries by really selling on red days.
yeah,
Let's say, like, yeah, I think in May, April of this year, we had some red days. I definitely sold on those red days, but I made sure not to sell everything. Just like every other day, I'll sell it, like gradually add trades in those red days, because I don't know what the lowest point is, but I definitely can't miss out on these high premiums. So I try to play, but make sure that I'm not putting everything in one trade, and make sure that I have enough buying power to keep trading and to manage the breach trades. But yeah, but March was definitely it was crazy. It was crazy. But
do
yeah,
you keep a watch list, the stocks that you enjoy
yeah,
trading, or do you more
yeah.
stand on like IVR? And then do you
I,
believe,
to, I used to look at IVR. Right now, I don't even look at IVR anymore. I just look at my watch list. So I pick my
okay,
stocks.
so that's similar to what I do.
Yeah, I prefer quality stocks, that like stocks
Yeah,
that I know. And
because
anyways,
then if they are breached, then you're confident that, okay, this stock is a legitimate company. As
yeah,
long as I roll it out in time,
yeah.
eventually it's going to stabilize.
Exactly. Plus, when I sell a put on a stock, I already know just by looking at the premium if it's high volatility or not. Like if I'm like I don't know if I'm 10 points or 20 points out of the money, I'm collecting $2 or $3,
Right.
depending on the
Exactly.
price of the stock. Like I already feel it if it has a high IV or not without even looking at IVR.
Yeah.
Um, yeah. So yeah, I've
If a trade gets challenged, so is your goal to then, because I noticed that you mentioned Spotify and then you mentioned the expiration is July. And my initial thought was, oh, that's fantastic. Your expiration is in July. So that's a few weeks from now. So even in the worst case scenario, even in like the nuclear option, you can roll out that position by about 4 to 6 months and roll it down to about 210 or 215. And that's the worst case. And then you would say, okay, well, Spotify, I think you said that I don't follow it tremendously, but I think you said that its high was like 380, right?
yeah,
So
yeah,
you're thinking, okay, worst case scenario, as long as you keep adequate buying power, if you even had to buy Spotify at $210, knowing that some people bought it at around 370, 380, and then if you took ownership, and I know that taking ownership of shares is not ever preferable for many people because of the buying power requirements. You're looking at 50% buying power reduction for owning stock relative to like 15 or 20% for selling options. But even in the worst case scenario, if you were to take ownership at 210, you can then sell calls on that to reduce your basis. So
yeah,
I think that the the big the big rather, the important factor here is if a trade does get challenged, I think that by keeping your expirations relatively manageable, so that therefore your expiration now is, I think you said 260, right?
250. Yeah, my strike
250,
is 250. Yeah. I
250,
rolled it. I rolled it down. I rolled it down.
okay, and it expires in July. So in the worst case scenario, you can roll that forward in time by another month, reduce it by about
Yeah,
$5 or $10.
absolutely.
You're
Yeah.
not you're not getting spooked, and the first time it's challenged, rolling it out 6 months in time. Instead, once it gets challenged, you're trying to get rid of it as quickly as possible, but at the same time, rolling it to a strike that's more advantageous. Is that accurate?
Yeah. So I try to hold on to it till expiry, but then on the last day it got breached, so I rolled it for 1 week. The first time I rolled it for 1 week because I felt it was going to come back up because I felt it was oversold. I was
Right.
wrong. It dropped even more the next week. So my initial strike was 260. I rolled it to the following week to 257.5. And then that next week, I think it dropped to 230. So
So,
that's where I had to roll it like 45 days. I rolled it to July and I rolled it from 257.5 to 250.
so
And then
on
it went all the way down to 215. And now I'm just waiting for it to come back up.
so on expiration day,
Yeah.
it became in the money, and then
Yeah.
you only rolled it forward 1 week in time to reduce it by $2.50.
Yeah.
In my
With
opinion,
a credit though.
yeah, I understand. In my opinion, and sorry, I'm not in any way trying to be critical, I feel that that might have been a little bit greedy on your
Yeah.
part,
It
because
was.
if you think about it, like in that situation when probably that might have been the only position that you held in your portfolio that was being challenged. So if that was me, I would have thought, okay, like I just want to get rid of this position, and this is the day of expiration, so there's virtually no more extrinsic. It's only
Yeah.
intrinsic. You could have rolled it forward by the next week, collected like much less premium, and probably rolled that down below 250, or at least to
Yeah.
like at
Yeah.
least to 250. But instead what you did was you thought, oh no, like this is an
Yeah.
outlier event, like next
Yeah.
week it'll probably bounce back, but wow, I can roll the floor by 1 week, reduce the strike by $2.50, and pick up an extra $2 or $200 for every contract. I want to do that. But instead, what I would have done is I would have allocated that premium that I would have collected in order to roll down that strike even more, because
Yeah.
I would have wanted to get rid of that position ASAP. And
Yeah.
look, the way that you did it, maybe 8 out of 10, and I've done it that way too. And I've made money sometimes, and sometimes I've also got burned. But I think that when a position gets challenged, your first and primary goal should be to get rid of that position without sustaining a major loss. And me personally, I would have tried to roll that down to about 250, because remember, once it does get challenged, like it's much harder to roll that position once it becomes in the money. Like you
Absolutely.
can
Yeah.
only roll it to much less advantageous
Yeah.
position,
I
much
think
advantageous strikes.
Yeah, I think if I had rolled directly to July that week, I could have gone to the 230 strike.
Yeah.
So
Mm-hmm.
yeah, definitely, yeah. I only roll when there's no more extrinsic value in the option that I'm holding because I don't
Okay,
want
so you
I don't
wait until the
yeah, I don't
okay.
want to pay for extrinsic value when I roll.
Mm-hmm.
So I wait till there's no more extrinsic and then I roll. Also to avoid early assignment as well. So I
Yep.
roll before there's no more extrinsic value. Yeah.
So how you wait until, generally speaking, there is some type of assignment risk when there's like probably around like 10 cents or
Yeah.
less, like maybe 15,
Yeah.
depending on how expensive the underlying stock is. But so
Around
you
that. Yeah.
so you really try to like milk out as
Yeah.
much. Okay, I what I usually do is I will roll when I feel that there's a high probability of the stock is going to expire in the money. So, and the reason for that is I'm always scared that a stock is going to expire in the money. And I know that if I roll too early, it's better than rolling too late, because if you roll when a position is already in the money,
Yeah.
it's much more difficult to decrease on the put side,
Yeah.
to decrease your put to be more advantageous and roll down that put. Whereas even in Spotify, using that as an example, if I had rolled it from, let's say you had 260 and Spotify was trading at like 263, and it was probably
Yeah.
like, it was, you could have
Yeah.
rolled that down, maybe not to 250, but you could have rolled it down to like 252 and a half. And I just always think that when you're selling options, you have a high probability of profit. For those positions which get challenged, they scare me. And I always want to, I change my mindset from, okay, I want
Making
to
money to saving
make
it. Yeah.
money. I want to make sure I protect myself.
Yeah, I get it. Yeah, absolutely. Yeah. But I was confident about Spotify because I saw it at 380, it dropped to 350 and then to 310 and then it actually dropped to 260, went back up to 290, and then after earnings it dropped even lower. So I was confident in that situation. So you will roll before it goes in the money.
Yeah, I'll
Okay. Yeah,
I
I don't know. I feel like I'm basically not giving it a chance to maybe win. Maybe I'm rolling when I didn't have to roll. I usually I try to let it play out. Yeah. If
I
I
would say
yeah
I roll a lot of times where looking back in hindsight, it was unnecessary
yeah
and I was too early. I would say that because rolling, I believe, is more of an art than a science. Because, okay, when you place a new trade, you're kind of asking yourself, you're looking at the premium and you're choosing a strike. And then you're like, do I think that this strike is going to get challenged? And you're like, and you're probably thinking, no, I don't think that this strike is going to get challenged. And then you say, okay, how much premium is available on this strike that I'm selling? And then you're thinking, oh, wow, there's $3. And then you're thinking, am I being compensated enough for taking this risk by selling this strike price, right? And
yeah
then if the answer is yes, then you end up making the trade. If the answer is no, then you say, oh, maybe I'll increase the strike price by about $5 and then I'll see how much premium that is. Do I think that that's worth it? It's kind of like an internal, because based upon your experience, you made a significant amount of trades. You kind of like ask yourself, do you think that you're collecting enough premium to compensate you for your perception of the risk that you're taking? But when you roll a position, it's kind of like you don't know, like the stock is so close to being in the money. Should I roll it now or should I wait? And I can tell you that many of the rolls that I make are completely unnecessary. But I will say that I think in hindsight, if you take everything in aggregate, I think that rolling a little bit too early and reducing the risk, and even if you have to roll down that strike price significantly to reduce your risk and also increase your buying power at the same time, I think that in general, you might be better off.
yeah. Okay, makes sense. Yeah. So how do you play earnings?
For earnings, what I do is I shorten up the expirations because generally earnings are a binary event. So then once something reports earnings, then you see an immediate volatility contraction. And what I usually will do will be close out the situation. What I like earnings is basically I shorten the expirations and I widen out the strikes even more. That's pretty much it. And earnings are my most profitable time because the volatility in the underlying stocks increased tremendously. So it affords you the opportunity to sell a put strike that's further out of the money, or if you're going to sell a call, you can sell one that's further out of the money, collect a significant amount of premium, and then immediately after the earnings announcement, you can usually close it out.
Absolutely. Yeah. Yeah, that's the plan. Yeah. But so you sell puts or calls or
I will sell a put on earnings if I think something is oversold, and I will sell a call. Okay, so here's a good example.
yeah.
I right now am so for about 3 months, I was selling a lot of Amazon call, or rather a lot of Amazon puts, because Amazon was trading around between like 3,100 and 3,300. And I was selling a tremendous amount of puts on Amazon, anywhere between like 2,200 and like 2,600. And I was collecting a decent amount of premium. And because I used portfolio margin, it really wasn't using up a significant amount of buying power because those puts were so far out of the money. But right now, with Amazon trading at about 3,500, I'm actually short a 3,800 call option that expires this week. And I'm thinking about even selling like a 4,000 or a 4,100 that expires in a few weeks because one, I believe the general direction of the market at this moment is down, but alternatively, the available premium, even on the call side, due to the volatility expansion, is
Yeah.
actually really, really high.
So you're not
So
afraid of naked calls?
I would say that I am afraid of naked calls when it comes to stocks like GameStop or
Yeah, yeah, of
even
course. Yeah.
stocks like Tesla,
Okay.
where I think it was January 6th or 7th or 8th, maybe January 7th or 8th of 2021, when Tesla increased in value by like 17% in like 2 days. Um, I think for calls, I would be very hesitant to sell calls. Okay, on calls, I will sell significantly less of them than I will on puts because I am scared of calls. But I think longer term, I'm less scared of calls than I am on puts because the calls, when a stock goes up, it usually goes up a little bit like stair step, right? So I'll sell calls on something like Amazon where I figure, okay, if it does hit 3,800, then I can roll it out, especially because it's expiring this upcoming Friday, right?
Yeah, that's
Let's say,
fine.
and it's $300 out of the money. So
Yeah.
you have 5 days for it to go up around $250 or $300, right?
Yeah.
Around then, I think it's around 3,500.
Yeah.
Realistically speaking, it's going to take at least like 3 days for it to even challenge because I mean, look, it's $300 out of the money. So even if it goes up $100 each day, then realistically it'll be Wednesday and it'll be trading at about, let's say, 37.50. Okay. Even in that scenario, I can roll it forward in time by 1 or 2 weeks and roll it up above or to above 3,900, probably more to like 4,000, at which time Amazon will have gone up around 20% in like 5 or 6 weeks, at which time I feel very comfortable that just by
Yeah.
rolling it out in time, that eventually, if I keep my expiration relatively close to the current date, eventually it's going to have some type of pullback. So I guess my rules for selling calls are I want to make sure that it's overextended to the upside. I want to make sure that it's not going to be a stock that has a large takeover risk, like a GameStop or even a
Yeah,
Tesla.
no, never in the game stuff. Yeah.
Right. Like even realistically, like something like Tesla. And then additionally, I want to make sure that my sizing would be around one call for every like 3 puts, meaning that if I'm short for Amazon, so I'm short about like right now, I think I have about 5 or 6 short put positions that are pretty far out of the money, right? They're about like 2,500, 26, 2,700, and I'm short one 3,800 call.
All
In
same expiry though, or different expiries?
no different expirations.
Okay.
But in the worst case scenario, I can roll up that short put because it's so far out of the money from 2,500. And if I want to, I can roll that up from 25 to 2,900, keep the expiration the same because I'm rolling it up by $400. And remember, the only problem that you're going to have is, or rather, if if Amazon keeps increasing in price, then that 2,500 short put option, rolling it up from 25 to 29, even though you're increasing it by $400, it's really not at risk of getting challenged because the Amazon stock is also going up in price. So if you roll it up by $400, you're probably going to be able to collect another $500 to $700, right?
Yeah.
You
Yeah.
can then take that premium by rolling up the short put, allocate it towards increasing the short call strike from 3,800 and probably roll it up to about 3860,
Okay.
thirty-eight
So
seventy,
rolling the call for a debit, basically from the credit that
and
you collected from
financing it by
rolling. Yeah.
rolling up the short put from
Okay.
25 to 29. So I think, for the calls, as long as you keep them really small, you keep the expirations very close to the current market price. You don't do it on a stock that has a high takeover risk, like even something like Tesla. And then also you make sure that you keep it unbalanced where if
Yeah.
you feel more comfortable on the put side, which in general you do, except when the market crashes, then maybe you have like 3 or 4 put options for every one call option.
What's the okay? And so what's the last earnings you played? The stock.
That's earnings.
Which stock did you play? Did you play Zoom?
No, I didn't. I didn't do Zoom. Yeah, because
Okay.
Zoom scares me a little bit because I just don't know. A lot of that is like COVID related, and I just don't know like really what its value like.
Yeah.
It's hard to know like fundamentals, like oh, what's the true value of the stock? But when a stock has like such a wide 52-week range,
Yeah.
I have no. It like scares me because I'm like okay, so if this range is like 100 to like 400 and it's trading at like 260. I have no idea. I don't really follow Zoom, but if it's like so wide,
Yeah.
I'm like, okay, that kind of scares me because if I sell a put, like it could actually fall to like, to 100 and then I don't want to touch that.
Yeah. 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 It was at 600 almost at one point. Now it's at 360. Yeah. But last Zoom earnings, I sold a 300 put It was trading at around 330. It dropped a little bit after earnings. It was pretty much flat after earnings. So it was like sold it like on Tuesday before the close, sold it for $4. Wednesday morning, closed it for 50 cents.
Yeah,
So
that's
I love these plays. Like sometimes actually a good way of mitigating like the next crash. I'm thinking, what if I just play earnings always? Like I think a viable strategy is don't do trades regularly. Just try to play earnings in any situation, because even during March, earnings selling puts on earnings would have been good because VIX was super high. So your short strike would have been far. You would have collected a nice premium. And a lot of these stocks went up after earnings or stayed flat after earnings, or even if they dropped, they didn't drop that much after earnings. So sometimes I think playing earnings only is probably like a viable strategy to avoid all this market craziness. Even if you go in with the mindset of or the intention of, if it's a loser, I close it, take the loss, move on. But if so you're never in a trade over the weekend. You're always in cash at the end of the week, and you just play earnings. I think that's, if someone could back test this, I think it's a viable strategy, like an out of the money put spread on like earnings like Netflix, Amazon, Google, quality names. And then if it's a put spread, so your loss is capped, or you could do a naked put, but then you don't know what you could lose potentially on if a stock drops hard. But
Well,
yeah,
that would also be extremely efficient way to trade too, because that would mean that for all intents and purposes, you would be trading for like 4 months out of the year, right? So you'd be trading for like, March, June,
yeah.
etc. I mean, that would be pretty, and you'd be collecting premiums when they're the highest.
I find my best trades are usually my earning trades. So
Yeah,
yeah,
mine too. Yeah, I
I
make the
enjoy
most
that.
money in earnings. Yeah.
Yeah, I enjoy it. There was some guy who was doing short straddles for earnings, but that's too crazy. Uh, what do you think of
Yeah, I
that?
wouldn't straddle. I don't think I've ever done a straddle, to be honest.
Okay,
I
yeah,
just because it's kind of like it's a little bit like, I know that the odds are in your favor, but it's a little too much like gambling, where it's like I don't know,
It-
straddles. I don't want to deal with, it incessantly, like checking on the stock or being concerned if something moves a little bit too far out of the money. I know that you are a little too far. I know you can make good money by selling straddles, but it's not for me. It's too anxiety provoking.
so your videos, you have a lot of videos where you say like Tasty Trade is a scam or Option Alpha is a scam. Do you really believe that, or it's just just a
Well,
great?
I think Tasty
I
Trade
don't think
is
you believe
is
it.
yeah, I think Tasty Trade's a great resource.
Yeah.
Um, Option Alpha, I think there's a possibility that I might release like a follow-up video. Um, but with Tasty Trade, I have so much respect for Tom Sosnoff. I mean, um, he's built multiple businesses, and he's probably
Yeah.
worth, he sold,
Yeah. He's a
he
serial
got like
entrepreneur. Yeah.
yeah, he's probably worth like hundreds of millions of dollars. And also he's around 60 years old. And I think he started Thinkorswim when he was like 40 or something. And I think that's incredibly respectful. And I think that trading, especially with options trading, so many people get caught up in like the minutia, and they say, oh, like, um, you have to like learn everything as possible. But the reality from what I've seen is that those people who are the most disciplined and who are the most patient are usually the ones who do the best. And I think that with Tasty Trade, I am a little bit concerned that they encourage people to trade too often. But in general,
Yeah.
I strongly believe that, one, I have tremendous respect for Tom Sosnoff. Um, every time I email him, he emails me back. Actually,
Yeah.
did he respond to your email?
Yeah.
He,
Yeah. Yeah.
yeah. And look, for someone who for someone who has like the intrinsic motivation to just love what he does, like
Yeah.
I don't think you can ever like not respect someone like that. I
Yeah.
think
Yeah.
that Tom Sosnoff has good intent. And just because I don't agree with everything that he says doesn't mean that I'm right or that he's wrong. Like, it doesn't mean that. So I have tremendous respect for Tasty Trade. So yeah, maybe some of like the videos that I put out that were critical at Tasty Trade, maybe they were like a little bit like clickbait thing, you know. But yeah, I have tremendous respect for Tasty Trade, and I think that it's a great research. I respect Tom Sosnoff, I respect Tony, I respect what they do, the time and effort that they put in, and at the end of the day, like a lot of us are option sellers. So as long as you have positive intent and you might have like a different flavor of the best way of going about it, I think that all those people deserve your respect.
Yeah, but I think when they say trade often, it's because they're talking about probabilities. If you treat it as probabilities, they're saying trade often, you said, like an insurance company. An insurance company will not have one client; they'll have
Mhm.
several clients, right? So he's comparing clients to underlyings
Yeah.
or trades. So if you want the probabilities to work out, you need to have several trades. And so I guess that's what he means by trade often, is that let's say let's say Facebook drops 5%, you're not going to sell a put and out of the money put with all your buying power, because anything's possible. It could continue to drop. So you still, even if you think it's a good trade, you still want to keep your contract. You want to keep your size small just in case something crazy happens. So probably that's what he means is by trading often, it's just to spread out
Your risk.
yeah, exactly. So that the probabilities play out at the end. But yeah, I guess it could be misinterpreted, and yeah, but to me it makes sense. But it's hard to manage though. Lots of trades. That's the problem.
Yeah,
It become
Tom.
overwhelming, and you could start closing positions just because it's overwhelming and taking losses. Apparently, he does like 80 trades. So
Yeah, I was just going
that's
to
the
say
first
that.
question I'm going to ask him. Like,
Yeah.
what are you
How can you
trading?
manage 80 underlyings? Like, I
I,
just don't understand
I see. That's the
because
thing. There's no way it's 80 different underlyings, because he's got a watch list as well. He goes for, like, liquid stuff and all that. So he doesn't. There's no way it's 80 different underlyings. I think it's the same underlyings, but it just different position, different after
so
different
different
movements of the
positions within
stock.
those underlyings.
Yeah,
It's just
exactly.
there
But
is a lot of correlation risk, and
yeah, it's too
I know
much.
that
Yeah,
when you have positions that are getting challenged, I would much rather see a condensed screen and say, okay, like I can take care of like these four or
yeah,
six positions where when you're going through a crash, there is tremendous mental anguish and stress that are
yeah,
going through.
absolutely. But he
So if you
doesn't.
have to repeat that process like 70 times, I think that you would just like get super depressed and like just close up shop and go to sleep and be like, okay, like I just can't deal with this anymore. But if
It's
you have 4 to 5, it's
yeah.
much easier.
It's probably he doesn't care. He probably has the money, so he doesn't. He's doing it because he enjoys it. He doesn't. I don't even think he cares about the P&L at the end of the day. I think he just cares about the probabilities being right. I think I
I
saw.
think my gut feeling is similar to how um, I trade smaller now than I did when before I started, selling courses and selling trade alerts. I think that because Tasty Trade and Tasty Works occupies so much of his time, I think that Tom has allocated and decreased his size so that he can factor in everything so that even in the worst case scenario, like what happened in March 2020, he's not going to be significantly disabled or anxious or stressed out so that he's not going to be able to carry on his duties. Because anytime you get, look, Tom doesn't need to work for the money. He's doing it because he's passionate about it. But
Exactly.
if he had 2 to 300 million dollars only trading options, and then March 2020 came around, I'm sure he'd be like, hey guys, I'm really sorry, but I've worked for the past 30 years to build up my net worth. And I would love to be on this hour, like, on this hour show with you and BS with Tony, but I need to like really focus on my positions. He didn't do that. Instead, what he did was he carried on like everything was fine. So my gut feeling, and I've never asked him this, but I believe he probably keeps maybe like 2 to 3%, because remember, he scalps as like an engagement tool, so he does believe that in engagement and staying active and just kind of like sharpening your wits, so it's kind of consistent with his existing beliefs. So my gut feeling is that he keeps about 2 to 3% or maybe less than 5% in his active trading account, which is still pretty sizable. It's probably like, 10 to $20 million. And he trades that back, where even in the worst case scenario where we run into another March 2020 and maybe he realizes like a 30 to 40 to 50% haircut, it's not the end of the world where he's going to be depressed about it. Because
I think he lost like 200,000 selling calls on GameStop, and he's still talking, no problem. So
yeah,
the 200K loss was nothing to him.
and I think the only way of doing that when you are educating is to keep your size small, and realize that you have different priorities. Like you're not going to put your entire account in there because trading is risky, and if the market goes up or the position goes against you, you don't want to be incredibly stressed out or depressed where you're not going to be able to carry on your responsibilities.
Do you use Tastyworks?
I have. I use Tastyworks and I also use E-Trade.
E-Trade, okay. And you have a Trade Alerts a program?
Yeah, product, yeah.
Okay. How much do you charge for that?
I charge $349 a month.
Oh yeah.
Mm-hmm.
And so obviously people have to make more than that just from your trades, from your
Yeah.
alerts. Okay.
So the break-even point is more. I'd say it's about like $15,000 or $20,000. Generally speaking, for people who have less, I don't recommend that they continuously subscribe because they won't make enough to pay the monthly rate. So if they if they want to join for like a month and then use it as like an educational tool and then trade on their own, but financially it won't make sense for them if they have less than like 15,000 because you're not going to make enough.
I charge $25, man. You're making me feel bad. But I'm just starting, so we'll see. But it's been going well. And but I learned everything. Honestly, I learned everything from Option Alpha. I know you don't. I think you don't like him, but I liked his videos. I learned everything from Option Alpha. He explains very well. But I don't necessarily like. I don't sign up to his trade alerts at all. I don't like his trades, but his videos explaining options and the edge in selling options versus buying options, I think that really helped me, doing what I'm doing right now. So I like his videos, but I don't sell his way. And then from my own experience, I developed my own strategy, my own approach. But Option Alpha, Tasty Trade, even Skyview Trading, their videos really helped me understand options and open my eyes to selling options as well.
And you're a CPA, right?
Yeah, I'm an accountant. Yeah.
And are you still practicing?
I work full time. Yeah, I work full time as a tax content analyst.
Okay.
So I do income tax. Yeah.
And do you think that in like do you enjoy that?
Yeah, I enjoy it a lot. Yeah, I enjoy my job. Okay. Yeah, I love income taxes. Yeah, personal finance, anything personal finance, I enjoy. And do you think I can live off selling options?
Well, where do you see yourself in like 5 years? Like, where do you see, because you have multiple sources of income. You have the full-time. Are you employed by someone or do you have your own
employed
firm?
I'm employed. Yeah.
Okay. So where do you see yourself in like 5 years, and what do you enjoy doing? Like, ideally speaking.
I hope to keep my job. I really enjoy it. I don't plan on leaving it. See, that's the difference between if you work for a paycheck or if you work because you enjoy it. If you enjoy your job, it doesn't feel like work, right?
Yeah.
So I don't plan on leaving it, even if I have enough money. I don't plan on leaving my job. My goal is to prove to myself that I can live off options, that I can be financially free of selling options just in case anything happens. So I don't have that fear, or I don't feel like I'm dependent on someone. So my goal is just to keep proving to myself that I can make a living selling options. And then I started YouTube because I was on parental leave and I got bored and I saw a lot of people are like making crazy money off YouTube. So I decided to try it. And I like personal finance. So I started off doing like tutorials on Questrade, which is a Canadian broker. So I started off doing tutorials on Questrade and just continued. Then started sharing my trades. Like I share all my trades on YouTube, trade recap, my P&L, my portfolio. just because I enjoy it. I like talking about it. But obviously the quality of my videos are not there. Like I work full time. I have 2 kids. So I really like, I do it at the end of the day when I'm super tired. So
It's
I
a
don't,
hobby. Yeah, it's not
yeah, exactly. I'm doing it as a hobby, but it's fun.
right.
Like the community is fun. I've made some friends off YouTube. I've actually learned from subscribers as well, from people's comments, and like it actually improved my trading as well. So no, I really enjoy it, and I'm just making a few dollars from AdSense. But I got some people for the trade alerts, and it's improving my option selling as well. Learning from people, like I have people in my trade alerts group that are actually doing riskier trades than me,
Yeah.
doing like naked puts on like really expensive stocks, and
That happens all the time because
yeah, it's funny.
a lot of them, they haven't been burned before. It's kind of
Yeah,
like like our kids, right? They think that they can do risky things and that they're never going to get hurt and then nothing bad is ever going to happen to them. But us, like since we're older, we know that no, we have to treat our body like a temple, because if we don't, then think bad things are going to happen in the future. And like when you're a newbie trader and you win like 10 straight
yeah,
trades
it gets to your head.
and
Yeah,
then your trades haven't even gotten challenged, you're
yeah,
thinking, wow, why
it's
am I
just so
selling
easy.
something that's this far out of the money when none of my prior
Yeah,
trades have even gotten challenged? I'm going to sell something much closer to the current market price of the stock, collect even more premium, and then if they get unlucky, then it lends itself to become a problem.
yeah. Here, let me well, let's see if I can. Do you see my screen? I want to share my screen. I hope it doesn't
I,
break anything.
yeah, I don't see it
Yeah, it's coming. Let me know if you see it.
right now. It said it's starting it. Yep.
You see my screen?
Mm-hmm.
Yeah. So yeah, I log all my trades. So these are the trades that I currently have open.
Oh, you're long some stock because you have covered calls, right?
Well, the only reason I do covered calls is because in Canada we cannot sell puts in our registered accounts, which I think you have like Roth IRA and RA.
Okay, yeah, in retirement, right?
Yeah. So we have TFSA and RSP. We can't sell puts in these accounts. So I use a covered call just to simulate a put.
Okay,
So I do an in the money covered call to simulate an out of the money put, basically.
in the money cover. Okay, I understand. Yep.
To simulate an out of the money put. So that's basically
Okay.
all it is. Yeah, so I've got that put spread on SPY there that I was telling you about. It actually got filled after hours, because SPY you can trade for like 15 minutes after close.
Mm-hmm.
So SPY took a big drop at the end of the day,
Yeah.
and this put spread got filled. I had an exaggerated order on, and it got filled after hours. So 80 cents, 402 strike for July 16,
Mm-hmm.
and I
Yeah,
got
that's pretty good amount of premium for $5 wide put spread.
yeah, and 402 strike, yeah. And then this is a covered call in my registered account. They're okay, Rocket, Luminar. I got a Bitcoin ETF, but as you can see, I only do one contract. So I
Mm-hmm.
don't I keep it really small just in case I'm wrong on the trade.
But you're trading a lot of underlines.
It just happened, man. But I still have like 80% available. But I'm doing one contract, that's why.
Mm-hmm.
So that's why I'm able
Yeah,
to do it.
and I think the underlying the strike price is very low. So on average, it looks like yeah, or I guess the median it would probably be about $30 for the strike. So it's pretty inexpensive. So it's not using up a lot of
Yeah,
buying power.
exactly. Yeah, I try to do a lot of $20, $30 stocks, but
Yep.
then obviously that forces me to pick stocks that I don't really like.
Yeah. Yeah.
But that's why I've got a few like expensive
Hmm.
ones like Spotify. I've got Etsy here at
Yep.
150. Yeah, and then the ones here from October to December are pretty much ones that I'm trying to save, and I rolled it so far out. So these ones are all pretty bad. So they don't
Yeah, but
really.
your snow. So I
Yeah,
actually had a bad situation with snow as well, where I got
yeah,
whipsawed, where it increased in price to about like 444, 446, and then I sold a 370 put, and then it fell all the way down to about two to like 250, and it
yeah,
took me like 2 or 3 months, and I finally got rid of it, and I maybe made like $200. Was it worth it? Definitely not, because it
yeah.
was very stressful and it took me like a few months. But the best thing that I see about, do you know what I'm going to say? The best thing that I see about your position,
Is that my strike is low and it has a
it's
December
only ten
expiry?
dollars wide. It's only
Oh
ten
yeah,
dollars wide. So
yeah.
it's
It's a
like,
put
okay,
spread. Yeah,
worst case scenario, like Snow, I think it's a legitimate company. And it is pretty far out of the money because I think right now it's trading at what, like 240, 245 or something?
Yeah, it was even at 250. I think it closed in the 230s on Friday.
Okay.
Yeah.
So around, so it's still like relatively far out of the money and it's only $10 wide. So in that situation, you're protected.
Yeah, and it's in December, so I don't even have to worry about it. I'm not even
Yeah.
thinking about it. Oh, 249. Okay, that's good.
Yeah. So it's far out of the money. And actually it's impressive that it was up yesterday. It was up on Friday, considering that the
Yeah.
S&P was down 55 and after hours, it was down an incremental 15. So,
That's why you have to diversify and trade often so that even if the general market is down, maybe the underlying that you picked is actually up and it gives you a chance to win on trades, right?
how many positions, um, how
I
many
have
stocks do you have right now?
I have
All
20.
those are open?
Yeah, I have 21 open trades right now.
Yeah, I don't know, man. Like, I mean, if it
But
works for you, so be it.
it's across four different accounts. But what's the alternative? I don't think I should, I don't feel comfortable doing 10 contracts on one position because who's to say that it's a winner? I have to assume that it could lose. So I try
I
to
mean,
spread it out.
there is a lot of correlation risk in many of the stocks. I just
Plus,
yeah, I understand the argument. I just feel that um what I like to do with my alerts is I kind of try to like grade them, right? So
yeah, yeah,
if something I feel is a better opportunity, that and I see that you have like some contracts where you have like two, so in that
yeah.
situation,
These are cheap ones. Yeah,
if you feel that out of all those positions that you have, there have to be some of those positions that you feel more comfortable and better and more
yeah,
comfortable with than others. So what
yeah,
I personally would do is I would look at that and I would kind of like rank them. I would say, okay, which is this stock and which is the position that I feel the most comfortable with, and which are the positions that I feel the least comfortable with, and then maybe like the five on the bottom that I feel like the least comfortable with, I would actually increase the size of the top five that I feel the most comfortable with, and then close out or try to find a way to get rid of the bottom five. That's just me. I don't know. I just don't feel that every underlying should be treated the same because once you start following a stock and you get more comfortable,
yeah,
you kind of like, just like you said with snow, like you're like, okay, well, it's trading around 250. It sounds like you're pretty comfortable with snow, whereas with some of the other positions, you might be a little bit less comfortable where you're not as confident
yeah,
that it's not going to challenge your strike price.
yeah, yeah.
But I
Sometimes
do understand like the math, and I'm not I'm not like being critical or saying like, oh, like this is the only way to trade. No, I
that's a
that's
thing.
I'm not
No
saying that
one.
at all. It's just my personal preference.
Yeah, no, that's the thing. I don't even think there is one right approach. Uh, if I think there are many ways to sell options and still make money, but you got to go with what's comfortable with what you're comfortable with as well, because what you're capable of managing and dealing, and also with the stress as well. But yeah,
Yeah,
sometimes I feel
stress is
like sometimes I regret having all these trades, and maybe if I had just done like 10 contracts on one of these winning trades, it would have been better off as well. Like, but I don't know. I feel like going into a trade, I always feel like I could be wrong. I always assume
yeah,
that I could be wrong. So I'm not comfortable to put 10 contracts. And like Peloton, for example, I like selling puts on Peloton. But like at some point when with the treadmill recall, it dropped so
yeah.
much. I had a
Did it
120.
drop below 90?
It went to 81. It dropped all the
Oh,
way
okay.
down to 81. I had a 120 put, but I closed it for a profit before that. So I was lucky. But when it dropped to 81, you better believe that I sold a new put.
Mhm.
For earnings, I sold a 75 put when it dropped all the way down. And when I sold the 75 put, it was trading at around, I think, 86, and it continued
So
dropping.
you probably collected, and what was the, how
I,
far out did you
I
sell it?
1 week, I just collected a
So you
dollar.
still probably, oh, okay.
It's gone. It's gone. But Peloton is a stock that I try to get back in, but I try to wait for a red day. That's my problem. So I'm a little bit picky on the entry. So yeah, that's the
That's a good
thing.
problem to have because,
But
like you said,
sometimes you want your cash to work, or else it's losing value with inflation, right?
yeah,
So sometimes I want like I'm 80% is available. So that's sometimes I wonder, what if, is it better to sell options with 20% of your buying power, or is it better to just dollar cost average on SPY, for example, with 100% of your buying power? I don't know.
I don't know. Like I don't. I know that. So SPX, you're a tax accountant. SPX in the U.S. is treated like a 1256 contract. So there's like special tax. There's special tax treatment in the United
Okay.
States with SPX. But even so, I just feel I maybe make like 5 trades a year on SPY, and I don't trade SPX. I like SPY,
Yeah.
and the reason is just there's less premium. Like it's just less. I feel like
Yeah. Well,
yeah, like
it only has high premiums when VIX is high.
yeah, yeah,
But
and
so can you say what your return was percentage wise in, let's say, 2020?
2020. No, like I'm not like I strive for a percentage of about a target of about 3% a year, or rather 3% a month.
Okay.
Um,
36 a
but
year. Yeah.
yeah, like this year we've been doing really well. I actually don't even know like what I've been at
Yeah.
this year. I know that um I I posted on a year to date like
Yeah.
all the trades. I can look at that, but I don't really look at I look at it at the like at the end, and I try to evaluate what mistakes I made and how I can improve. But
Okay.
I don't really look at like the I don't really look at the like at the month to month or like things like
Yeah.
that.
So you never question whether option selling is worth it?
I don't know. I just
Okay.
feel like what I do though is if because okay, I feel like option selling is worth it. I've never really questioned that it's not.
Okay. That's good.
Uh, but what I do is I always feel like if I lost money on a trade, then I feel like the that I made a mistake, and I
Okay.
strive to like to study that and say, okay, how can I improve so that it doesn't happen again?
Okay. Makes sense.
But
Yeah.
why you believe sometimes that there might be like better ways than selling options?
Sometimes I feel like maybe I was better off buying and holding, but like SPY or something, dollar cost averaging, just because I'm not using all my buying power.
Mm-hmm.
So am I really the return that I'm generating? I'm generating on like 20% of my whole buying power. Can that really be more than if I used 100% of my buying power and making, I don't know, 7, 8% per year on the SPY, for example? You know what I mean? So like I have to, you know what I mean? Like I'm
Okay,
using
so in that respect, why?
no, it
Okay, yeah,
just
I understand
sometimes it
where you're
comes to
coming
mind,
from,
but I'm still an option seller. I'm not gonna stop. But it
and
just
I mean,
sometimes it crosses my mind. Yeah.
and you can buy, and then you can also sell some covered calls on it. I was going to say, okay, if you wanted to use like more of your buying power, what you could do is you can sell like very aggressive strike prices on SPY and collect a lot of premium, but then that doesn't necessarily negate the thoughts, because if if you're going to be long SPY or long the market, then your primary means of making money is going to be in the upward participation of the appreciation. Whereas when you're
Yeah.
selling options, your maximum amount of premium is going to be the premium that you collect.
Yeah.
Um, yeah, I don't know. I've never really questioned that selling options was because I know that what the market does on average annually is going to be, maybe like 12%. And then if you're going to sell covered calls on that, maybe you'll get it up to about like 15 or 16%, because there will be a few times where the market increases in price and you're not going to be able to participate in that upward appreciation because your calls are going to get challenged. And I feel like pretty confident that if trading the right way, you should be able to, by selling options, you should be able to exceed,
Yeah.
like the
Yeah.
15% a year.
Yeah. Yeah. You're right. Yeah.
So I
If things go well, yeah.
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 All right. Should we wrap it up? It's getting pretty late.
Yeah, it is. Yeah. We spoke over an hour. Yeah, sure. Maybe wrap it up with a trade that you might do this week or you're
Oh man.
thinking of doing.
So this week I'm gonna be like very so tomorrow. Before I go to bed, I'm gonna check the futures market and then see where it's at. But I don't think I'm gonna make any trades. Um, tomorrow until like the afternoon, because I'm actually really curious to see like how the market's going to react, because it did scare me tremendously how the market was very weak into the close. At one time, I think the S&P was down like 35, and then it closed down like 55, and then after hours it dropped an incremental 15. And I know it's down pre-market now. So that scares me because I don't want to catch a falling knife.
Okay.
I have a lot of buying power on, and I have a lot of buying power available, and all my positions are my put positions are in spreads, and none of them are like, even if the market dropped like 15%, then it wouldn't be problematic. But I don't want to be too early when I do think that there's a decent chance that there's going to be some downside risk. So as far as like opportunities, but I know that Facebook was down around like $4.50 or something on Friday, I believe. I think that's decent, even though it's trading at around, I think like 330. So I would like Facebook to drop below 320, at which time I would probably sell like a 295 put option.
How many days to expiration?
I'd probably, given the market uncertainty, I would try to sell around 3 weeks out. I wouldn't want, and the benefit of trading something when you have increased uncertainty, the benefit of trading something that has a shortened duration and shortened expiration is that if you're wrong and that trade ends up getting challenged, it's easier to roll out that position and manage it than if you sold something that's like 7 or 8 weeks away. Because if you sold something with an expiration of 2 months and then it gets challenged, you might then have to be forced to roll that position out like an incremental 3 or 4 months. Whereas if you're selling it with such a rapid theta decay where there's only like 3 weeks left, then figure that it's going to end up getting challenged, let's say like 2 weeks from now, in which case you can roll it out like a month, and you can roll down that like 295 put all the way down to about 270. So during periods of uncertainty, I try not to lengthen out the durations unless I feel that the VIX is at a high point and I feel that the market is stabilizing. So let's say the VIX is trading at like 50 and you're like, okay, the VIX was trading at, I'm just using this hypothetically. Let's say the VIX was trading at like 60. And I know that's like extremely rare. So let's say the VIX is trading at 40 and it was trading at 50 before. And the past 2 days, the market has increased relatively substantially. So you feel that it's going to continue increasing. There's going to be continual volatility contraction. In that case, where you want to take advantage of a high volatility and rich premiums in underlying stocks, then I do think it's okay when the market is already beaten down to then increase your expirations. But during periods like right now, where there's a lot of uncertainty and the market is relatively high, I think it's very risky to start selling like to sell pretty far out expirations.
Makes sense. Yeah. Okay. I was probably going to do maybe Nike and FedEx earnings. That's it. All right. It was, I really enjoyed chatting with you.
Yeah, it was a pleasure.
Yeah, honestly, better than I thought it would be. I enjoyed it.
Really? Wow.
Yeah.
Thank you. All right. So yeah, I really appreciate the call. I'm looking forward to hearing the call. I don't know if Tom did Tom say that he's going to get on with you, or?
Yeah, he said July 14th.
Yeah, I think that's amazing. I'm really looking forward to that. I'll also, what I might do, how about like I do like a reaction video or something? I'm really curious if you ask him about like how many positions he has on and how he manages it.
I will. That's one of my questions for sure. Yeah. Put your questions on as a comment in the video where I said I'm gonna email it. So just so that I have a list of all the questions in one place. I'm gonna ask him. I'm gonna prepare a list of questions. I still have a few weeks, and I'm gonna ask him for sure how he manages his trades. Mostly, how come what are his 80 trades? Is it different underlyings or is it the same underlying? And if it's the same underlying, is it really a benefit to trade the same underlying several times? It's basically like several contracts on the first initial trade, unless you really wait for the stock to make a move and then he opens a new trade. So it's like
Yeah,
a
yeah.
different trade, really.
But
You know?
that, yeah, that I do that sometimes too, right? Because I'm not going to plunge everything in one stock, because what happens if I'm wrong? But if he has like 80 different, I would be very surprised if he tells you that he has 80 different underlyings,
I don't think
because
so, no.
yeah,
So,
I would be surprised in that. All right, man, I got to go to sleep. It was a
yeah,
pleasure
same here,
speaking with
man.
you.
All right.
All right,
All
have
right.
a good night.
You too. Bye.